Hi everybody, I hope you're all having a great Sunday, ready for the next week and Upstart earnings on Tuesday. I wanted to come out and make a little video on how we differentiate between the price of a stock and sort of the valuation of a stock, price versus value, as I think it's a really key investment concept, and I'm not really sure that everybody understands it. I know I didn't understand it when I was first beginning, and I think if maybe you don't fully grasp it, if you start to really dive in and it clicks for you, you'll have this epiphany and you'll start to think about investing in an entirely different way. So I'm hoping that this video today can be helpful for investors who are seeking that sort of clarity. The same price is what you pay and value is what you get comes from Benjamin Graham, who wrote The Intelligent Investor, which is considered the Bible of value investing. Now, value investing has sort of evolved over time, but this key principle remains sort of steadfast. It's really unchanged. So the price is what you pay for a stock, right? Every day we see the price of stocks change. They can go up and they can go down, but that is the price that you have to pay for the stock, which is really the business, right? When you're an investor, you want to start thinking of everything not as tickers on a screen, not as stocks, but as businesses. So the price of these businesses, the valuation of these businesses changes every single day, but the inherent underlying value of the businesses don't really swing that much day to day, which is why Ben Graham later on in the book talks about Mr. Market and how he can be exuberantly optimistic and he can be very, very pessimistic. And so to be successful at investing, you want to sort of quantify the value of a business and then take advantage of the market mispricing that business. So that's a lot of words, right? So what does that really mean? So today we're going to look at a little example that I've made, and then we're going to look at cruise lines to sort of see how this is playing out real time inside the market and get a real good feel for kind of the cruise line that the market thinks is the best. I know a lot of us have been on cruises and they're all great companies, right? But which one is the best business? Which one is the best stock? Which one has the best value? That's what we want to look at today. But before we get there, let's just look at a very simple example, right? Company A and Company B. Company A has a share price of $525, and Company B has a share price of $9. So, which company is more expensive, or which stock is more expensive? Well, you can't answer the question based off the information that I just gave, right? The share price of a stock tells you absolutely nothing about it. All it is a reflection of how many total shares there are outstanding and how large the company's market cap is. So, for example, in this scenario, Company A got a much higher share price, but they only have 10 total shares out there. Company B has, a much lower share price of $9, but they have way more shares out there, 100 times more shares, so 1,000 shares relative to 10 for Company A. So if you look at the market caps of these companies, Company B is a little less, but almost double, twice the size of Company A. So Company B is actually a much larger company, meaning that the business is more expensive, you'd think, right, because it's bigger, than Company A. But is it more expensive? That's what we have to look at in this next line, which is something called an earnings multiple. But really, the key takeaway here from the beginning is that the share price of a company does not tell you anything about the company. All it tells you is how many shares are outstanding and whether or not the company has decided to split their stock. So if you hear of something called a stock split, essentially that would be like a company here, like Company A, who realizes that their share price is pretty high and knows that psychologically that is going to deter a lot of retail investors from buying their shares, because a retail investor is going to say, well, hey, Company A, it's $500 for one share, but Company B, it's only $9 for a share, so I can get so many more shares. So what Company A is going to do is all of a sudden they're going to say, hey, we want to get our share price down so that we can get more investors in. So what they'll do is they'll do a stock split, so they'll increase their amount of shares outstanding, and that will basically divide the price by however much they split by. So now instead of having 10 shares at a $525 stock price, Company A has split their stock 2 for 1, meaning if you owned 1 share, you would be given 2 after the split. But now shares are only worth $263 a share, and they're double the amount of shares outstanding. So that is the game that corporations will play on the stock price. Remember, the stock price means very little about a company. So Chipotle used to be like $1,000 stock, right? And everybody's like, oh, Chipotle is so expensive. Well, what did they do? They split their stock, so now it's only like $40 a share. So it's really, I guess, attracted a new wave of retail investors. But you have to be careful because, like once I said, I'm going to keep hammering it home. The price of a stock doesn't mean anything. What matters, how you quantify how expensive a stock is the earnings multiple. So if we're looking at Company A now and Company B again, we can see that Company B is a larger company. The market cap is $8,500, whereas Company A, despite having a higher share price, is a smaller company with a market cap of $5,250. Let's say that both companies make $300 a year in earnings. So that would be like their bottom line earnings. So after they pay off all their expenses, this is how much money the company is making a year. So if we look at that as earnings per share, you would just take that net income divided by how many shares, right? So Company A is making $15 a share, whereas Company B is only making 30 cents a share. They're making the same exact amount of money, right? The difference is the denominator, which is how many shares you're dividing those earnings by. So once again, that just because Company A has a higher share price doesn't mean it's more expensive. If we actually look at an earnings multiple, so this would be the price or the market cap of the stock divided by the net income. You could also calculate this as earnings per share, share price divided by earnings per share, and you will get the exact same thing. You can use market cap or you can use EPS. So essentially what we're seeing here is Company A is actually trading at 17.5 times earnings, whereas Company B is trading a little bit over 28 times earnings. So really, Company A is much less expensive than Company B is. Company B is way more expensive, has a much higher earnings multiple, even though it has a lower share price. So in theory, a stock that is a $1,000 stock price can be significantly cheaper than a stock price that is $5. So these are the things that you want to look out for when you're investing in companies. It's just that first level thinking would be to say, oh wow, that stock price is so high, it's super expensive. That's not inherently true. That logic is really kind of flawed, and you have to peel back the layers a little bit more and go a little bit deeper into the financials. So what you'll see is, let's say Company A and Company B compete in the same industry, right? They're both doing cruises, because we're going to talk about cruise ships here soon. Well, if Company A is a cruise line and Company B is a cruise line, what can we infer about what the market thinks about these cruise lines right now? Well, we can think that since they're assigning a higher valuation multiple to Company B, they may be a little bit more optimistic or rosy about Company B's short-term and long-term prospects. For instance, Company B may be growing their earnings a little bit more. They may have a little bit less debt. Whereas Company A, even though maybe it's a formidable name and the business is doing well, it's trading at a lower valuation, probably because their sales aren't as strong, their brand recognition isn't as strong, and maybe they're carrying a little bit more debt, all which would make sense that you would not want to pay as much for Company A as you would Company B, right? Because why would I want to pay the same price for Company A when their business is really not as good as Company B? So that explains the valuation discrepancy. And so what you'll see is market leaders like Palantir, Tesla, Nvidia, right? All of these companies trade at higher valuations. And so most people, or most bears rather, will say, oh, well, the stock is so expensive, like it's just too expensive. And some of them definitely are too expensive. But the reason that they're getting that premium valuation is because they're standing out in their industry, or it's a very good business that can't be replicated, or it has a long history of great execution. So the price of a stock is not really the share price, it's the valuation multiple. And so what you want to do from there, and you can use many different valuation multiples, we'll look at another one here soon, but what you want to do is you want to look for companies where the price, meaning the share price or the earnings multiple, is significantly less than what the value of the business can provide over long periods of time. For instance, maybe you're looking at company A and you're saying, okay, they're paying down the debt, they've got sector tailwinds coming in, I'm seeing a new sort of marketing channel being pushed here. The brand is really popular with younger generations, and younger generations are growing up, and now maybe they're going to use this company's services a little bit more, right? So you'd start to develop a thesis as to the value of the business over long periods of time, how you think that will inflect in the financials, and then whether or not you think the stock is appropriately priced today. The problem is, if you wait until the story is clear, if you wait until the water is not murky at all, you're going to miss almost all of the gains, because the market is a very smart machine and it prices things very, very efficiently. So it's very rare that you find something in the market where it's sort of mispriced. So with that as context, I want to move now to the cruise line example. This is real data from these cruise lines. They are all publicly traded. You can go ahead and fact check me on this data. I just did it today. So this is accurate. So we've got 3 cruise lines. We've got CCL, that is Carnival Cruise Lines, NCLH, Norwegian Cruise Lines. I've been on a few Norwegian cruises, great experience, and Royal Caribbean, RCL. 3 different cruise lines. What is the first thing that we notice about them? Well, Carnival is trading at $29 a share, Norwegian is trading at $24 a share, and Royal Caribbean is at $314 a share. Wow, right? So immediately, a novice investor is going to say, wow, like these are all cruises, Norwegian is the cheapest one out of all of them, I'm going to buy it because the share price is the lowest. Okay, so maybe another investor is going to actually look at the market cap, and they're going to say, okay, Carnival is about a $40 billion company, Norwegian is about $11 billion, and Royal Caribbean is about $85 billion. So wow. So Royal Caribbean is almost double the size of Carnival and Norwegian combined. So it's very, very clear here that that Royal Caribbean is the largest cruise line that is publicly traded. So now we could maybe look at something like enterprise value. What is enterprise value? Well, enterprise value is a different way to look at a company's worth apart from market cap. Because let's say you're purchasing a share in a business, right? Well, it's good practice to sort of assume that you're taking over the entire business, even if you're buying only one share. So if I were to look at Carnival, right, and I'm buying the entire business today, well, I'm paying the $39 billion for the company outright, right? But then I'm also inheriting this $26 billion in debt that they have on their books. But in theory, if I buy out the company and I inherit the debt, I could use the cash that the company has to pay off some of the debt. So enterprise value is equal to market cap plus debt minus cash. And so it's a better way to get a more comprehensive look at the debt burden that a lot of firms carry. And for cruise lines, it takes a lot of money to build all of these ships. So naturally, they have a decent amount of debt. So if you go and you ever use a stock screener and you're looking at price to earnings multiples, and there's nothing wrong with the PE, you may find that a lot of the low multiple businesses there carry enormous debt loads, and that the reason that they trade at a low PE is because of that debt. And price to earnings sort of doesn't include debt. It abstains debt from the picture. So if you look at something called enterprise value, or it's abbreviated as EV, you see the market cap plus the debt minus the cash. So it gives you a more comprehensive overview of what would it cost to truly take over this entire business. Okay, so the enterprise value is going to be higher than the market cap for all 3 of these cruise lines because they have substantial amount of debts. So $63 billion for Carnival, $23 billion for Norwegian, and $102 billion for Royal Caribbean. We've talked about the cash. This is just how much cash they have on their books. Debt, this is long-term debt. A lot of companies will literally say long-term debt and then give you the number. Others will be a little bit more ambiguous and a little more digging is required. Net income. Right, that's just the profits. TTM up here in cell B2 just means trailing 12 months. So over the past 12 months, what are their earnings? What is their net income? The reason that I use trailing 12 months is because, like right now, we're in August, right? I can't use 2024 earnings because then I'd be missing Q1 and Q2 of 2025. So trailing 12 months is a good way to look at the past 4 quarters of data consecutively so that you can get a really comprehensive, accurate overview of the business today. So that's what this net income figure is here. It's how much money these companies, these cruise lines, have made over the last 12 months. EBITDA, right? This is probably a term that you've heard before. Well, EBITDA is earnings before interest, taxes, depreciation, and amortization. It's another way of sort of taking out the non-cash expenses and really looking at, okay, before interest, taxes, depreciation, and amortization, what were the earnings of a business? So for cruise lines, that EBITDA tends to be a lot higher than net income because they carry lots of debt and their cruise ships need maintenance and they can depreciate. So EBITDA is a better way to look at the true earnings of a business. It's not great for every industry, but I think it's rather comprehensive for cruise lines. Okay, so now we've looked at all of these, right? So we've explained all of these. And right now you're probably like, well, I really don't know what is the best business here. Royal Caribbean is trading at a higher share price than Carnival and Norwegian. Its market cap is also bigger than both of those combined. Well, let's see what the market is saying about this. So we've got two earnings multiples here, price to earnings and EV to EBITDA. EV, once again, means enterprise value. We touched a little bit on why I think that is a very valuable metric to look at. And then we're looking at enterprise value divided by EBITDA because we want to look at earnings before interest, taxes, depreciation, and amortization. So what do we notice right off the bat? Well, green is going to be the lowest valuation. Yellow is going to be second lowest, and then red is going to be the most expensive. So a couple things jump out at me right away. Number one, Norwegian and Carnival are almost priced the exact same. Literally almost identical. So that means that the market is feeling equally optimistic or pessimistic about both of these businesses. The price of these businesses is actually almost synonymous. They're almost identical, even though the share price is different and the market cap is different, right? So even though there's huge discrepancies there, the actual valuation multiples of this business are rather similar. Why? Probably because the market is unsure which of these two is going to be the second brand behind Royal Caribbean, which we'll touch on in a second. But if you wanted to go a step further, right, we always want to be peeling back new information. You would look at sales growth for Carnival. You would look at sales growth for Norwegian. You would look at the brand of both of these companies. You would look at the experience. You would look at, okay, which demographics, are they going for younger cruisers? Are they going for, is it more of a value cruise, right? All these different things are different between these brands. So then you would look deeper into the business, figure out which business you think has the most sustainable competitive advantage, which business you would rather be an owner of and an investor of, and you would sort of think of it from a bottom-up perspective. And if you came to the conclusion, I'm not saying you could, or you would, but you could, I guess, if you came to the conclusion that Carnival was a much superior business to Norwegian because of its unit economics, because of its customer base, because of its debt load, whatever it may be, right? Well, if Carnival is trading at the same price as Norwegian, it's going to make you think a little bit. Either that could mean Carnival is really undervalued, could mean that Norwegian is pretty overvalued, and you'd have to do more work from there, right? But the point is, you've identified sort of a discrepancy between what may actually be happening and what the market is saying is happening, because this is what the market is saying. The market is saying that these two brands are very, very similar, and they're equally optimistic and pessimistic about both of them. Whether or not that's true, I'm not sure. Over long periods of time, the market will price it correctly, but there are periods of time in which the market has it wrong. So if I was really interested in cruise lines, I would look at these two and I'd try to figure out which one is better. So the first thing that I would do, just as a little example, my Excel is giving me a hard time per usual. If I want to insert a row. Okay, so let's look at debt as a percentage of market cap. So let's just see which company is carrying a lot of debt relative to their actual market cap. So Carnival, sorry, my Excel hotkeys are being tough today, is 65.6%, right? Okay, Norwegian is 115%, so they have more debt than their company's trading for, market cap. Now, Royal Caribbean, only has 20%. So let's talk about Royal Caribbean now. Why do you think that the market is giving Royal Caribbean a much higher earnings multiple than Carnival and Norwegian? Well, number one, we immediately identified their debt burden is significantly less than those other two companies, which means their interest payments on the debt are going to be a lot less, which gives more room to the bottom line earnings. It can be very tough to eclipse interest payments on a debt load that's growing if the business is not doing well. That's part of the reason why Norwegian has been struggling lately. But there's some other things here too, right? This is not only a reflection of a better financial structure for Royal Caribbean, but in all likelihood, this is a reflection of a management team that has consistently delivered and met expectations, a management team that is very trustworthy, that hasn't had a lot of surprises. It's probably reflective of a business that hasn't been very volatile, that's been pretty steady, pretty predictable, pretty reliable, whereas Norwegian and Carnival maybe have been a little bit more turbulent coming out of COVID. And really the last part of it is this valuation is probably reflective of what the market believes an industry leader. Meaning they probably think that Royal Caribbean is the best cruise line with the best brand, with the best unit economics, with the best customer demographics, with the best ships, everything, the best service. That is probably what the market believes. So that is why I think the market is probably giving them a higher earnings multiple, that and a lower debt burden. So within about 10 or so minutes, we have identified between the three largest cruise lines a lot. We've identified that Royal Caribbean is the best, the biggest brand. The market is most optimistic about it. And we've identified, and they have a lower debt burden. And we've identified that Norwegian and Carnival are kind of like two peas in a pod. They have the same valuation, even though Norwegian has a much higher debt load, right? So if you're interested in cruises, figuring out which of these two is better is probably something that would be worthwhile. So how does this go back to price versus value, right? Well, the share price of these companies does not mean anything. It just so happens to be that Royal Caribbean, with the highest share price, is also the most expensive stock, gauging by the valuation multiples. But in that example that I showed you earlier, with company A and company B, that is not always the case. So the price is what you pay for a business. This is what you're paying right here. You're paying this price. The value of a business is what you're getting in acquiring it. So enterprise value is a little bit of the value, right? How much debt are you taking on? But really, how sustainable is the business? What are the unit economics of the business? What are the customer demographics? A lot of what we already talked about, sometimes those things aren't as quantifiable as you may think. If it's a cruise line with a stable, predictive history like Royal Caribbean, you can probably run a discounted cash flow model on it, which you've probably heard of. It's a great way to analyze the present value of all future cash flows for a business. Now, what's tough about that is great companies that fit or can easily be modeled in a DCF tend to already have premium valuations because the market has already done that DCF and it's already come to an estimate of fair value, and then in all likelihood, because the business is so phenomenal, it's probably received a premium. So really DCFs are very tough because it's hard to find inflection point businesses because the business already has to be pretty mature to be able to fit into a DCF. But, people do it all the time with value investing. So it's best, really, if I were looking at cruise lines, I'd say, okay, Royal Caribbean, this is the best one. If I just want exposure to the sector, it's probably the best place to go. Now, if I was yawn hungry and I really wanted to figure out everything about cruise lines, this is where I would look. Because I find it hard to believe that Carnival and Norwegian are really that identical in terms of their valuation. To me, it seems like almost certainly one of them has to be a better business than the other. My understanding is that this goes lower end budget cruise friendly for Carnival, middle end for Norwegian, and then really upscale for Royal Caribbean. So the fact that Norwegian and Carnival are priced the same, it makes me want to think a little bit more about these businesses. And I would go and I'd start reading the 10Ks and I would look at them, right? And I'd be like, okay, I like this about Norwegian, but I like this about Carnival. And I would just work myself through that reasoning as a business. So now that we've seen that, right, we can see the valuation multiples. What is the market saying about these companies, right? Okay, so this is COVID. Carnival crashed, right, like all other cruise lines. And it's rebounded pretty significantly since then. But it is, it's not recovered to where it was trading in 2018, kind of before COVID, and huge headwinds for the sector. If we look at Norwegian, very, very similar, right? Is a business that also plunged during COVID, has recovered pretty nicely off the lows, but is still nowhere near where it was just a few years before COVID. That makes sense, right? Because these businesses, remember, are priced the same. So the market is trading them also relatively similar. But now if you look at Royal Caribbean, we see a very clear difference. So this is the COVID crash right here. The stock is up probably twofold, almost 2.5-fold from its pre-COVID highs. So clearly this is a business that is doing much, much better. So the unit economics of the business, everything we've already talked about, is much more favorable, which then, it makes sense why the market is giving it a more premium valuation. But is that valuation too high for the value of what you're getting? Quite possibly. You would have to evaluate that yourself. But the key point of this exercise, and what I'm trying to show you all, is that the price of a company doesn't mean a lot. Really doesn't, unless you're talking about wanting to trade options. The valuation multiples of a company tell you a story about what the market thinks, right? All these numbers on my screen, there are no words on my screen right now. Well, there's like a few. But the numbers on the screen tell a story. And so it's your job as an analyst and as an investor to say, okay, what are these numbers telling me? And so I think anybody looking at this right now is going to say, okay, we know Royal Caribbean is the best cruise line. Norwegian and Carnival are priced the same. If I'm looking at cruise lines and I just want exposure, probably going with Royal Caribbean. If I want to look a little bit deeper, probably trying to figure out which one is better, Carnival or Norwegian, and seeing if I can get some alpha and trying to play a valuation change there. So that is my lecture today on price versus value. I hope it was insightful. Please let me know if you found it valuable with a comment or send me a message. And if you'd like to see more videos like that or like this, just let me know. So I hope everybody has a great rest of their weekend, and I'll see you all on Tuesday for Upstart Earnings.